Welcome to our channel Master Trader 1949X. Today we will explain about sovereign gold bonds. But before that, we request you to go through this disclaimer. The table you see on the screen depicts gold price history for last 99 years. So as to draw a conclusion, look at gold prices of year 1926, that is rupees 18.43. And now look at gold price in the year 1930, that is rupees 18.05. In 4 years gold prices reduced, or we can say there was no significant profit in gold investment. If you see gold prices in 1948, it was rupees 95 rupees and 87 paise, and in 1953 it was 73 rupees and 6 paise. There was significant drop in gold prices. In 1996, gold prices were 5,160 rupees, and in 2001 prices dropped to 4,300 rupees, which also indicates a decline in prices. Now we will see an overview of gold prices. In last 99-year gold prices have increased more than 3,500 folds. In last 50 years gold prices have increased 130 folds. In last 10 years gold prices have more than doubled. So by analyzing the chart, we come to the conclusion that gold prices have significantly increased in long term. This chart depicts rising gold prices over years. Hence, we conclude that gold is safe haven. It is a safe investment and it holds its value well during uncertain economic times. People often turn to gold as a reliable investment when markets are unstable. Looking at these trends, one more thing is clear, that one should not stop his wife from buying gold. But are there any more solid reasons to invest in gold? For sure there are reasons. Investing in gold offers a variety of advantages, including diversification, protection against inflation, stability during economic turmoil, and long-term wealth preservation. With its liquidity and ability to act as portfolio insurance, gold can play a valuable role in any investor's financial strategy. Investing in gold can be done through multiple ways, that is physical gold, ETFs, or sovereign gold bonds, each offering different benefits and risks. Let's talk about limitations of physical gold. While physical gold can offer a tangible asset and a hedge against economic uncertainty, it also comes with limitations such as storage costs, lack of income generation, illiquidity, counterfeit risks, market fluctuations, and limited divisibility. To skip these limitations, people consider sovereign gold bonds. But what are SGBs? It's a government-backed investment scheme, denominated in grams of gold, and it offers investors a way to invest in gold without owning physical gold. Investors purchase them by paying the issue price in cash, and upon maturity, they receive cash redemption. It's a government-backed investment scheme where investors can buy gold bonds issued by the Reserve Bank of India, RBI, on behalf of the Government of India. Let us throw some light on key differences between physical gold and SGBs. Physical gold is available in form of coins, jewelry, etc., and SGBs are available in digitalized paper format. While physical gold rates are highly volatile, SGBs have fixed rates, backed by Government of India. RBI opens SGBs investment window, unlike physical gold where one can invest anytime. Another difference that comes to light is the risk of physical gold to be stolen is high, as compared to SGBs. While physical gold is liquid and can be sold off in market anytime after purchase, sovereign gold bonds are issued for a tenure of 8 years, but one can redeem these gold bonds prematurely after 5 years. The premature redemption window opens every 6 months. The physical gold doesn't give any interest payment on investment, but bonds give 2.50% per annum interest, with interest earnings paid half-yearly. Physical gold doesn't require any demat account, same is the case with bonds. It is not compulsory to open a demat account. However, you can hold your units into demat account if you have one. Gold ETFs and sovereign gold bonds also differ. As we discussed that SGBs give 2.50% interest, the gold ETFs don't give interest to investors. If investing in gold ETFs, investors have to pay tax on long-term capital gain, whereas if you hold SGBs till its maturity, that is 8 years, there is no capital gain tax. But gold ETFs comes with no lock-in period unlike SGBs, that is 5 years. Gold ETFs have higher liquidity than SGBs. It is evident that SGBs come with variety of benefits. One major benefit of the sovereign gold bond scheme is the interest payment. The government provides a fixed annual interest rate on your SGB investment. This interest is paid biannually to the investor, regardless of fluctuations in the gold price. Second, redeeming your bonds after the maturity period of 8 years incurs no capital gains tax. However, if you redeem them after the 5th year, you may qualify for indexation benefits. The indexation benefit is applied to the investment amount to tax your returns fairly, which factors in inflation. Basically, indexation helps you to calculate the new value of your investment, considering inflation, and also help to get real capital gain. Third benefit of SGBs is security. Sovereign gold bonds provide a superior alternative to storing gold in physical form, eliminating the risks and costs associated with storage. Fourth advantage is, SGB eliminates concerns related to making charges and purity associated with gold in jewelry form. Last but not the least is that, SGBs are backed by the government. SGBs are deemed a secure investment choice. The transparent pricing system, tied to the gold market's value, guarantees fairness for investors. Individuals, HUFs, that is Hindu undivided families, trusts, universities, and charitable institutions are amongst eligible investors to invest in SGB, as defined by the Foreign Exchange Management Act, 1999. 2 or more eligible people can be named as co-owners of the same SGBs. But what is the limit for investment in SGBs? Trusts and other entities specified by the government can invest up to 20 kilograms worth of gold per fiscal year, that is April to March. In case of individual and HUFs, investors can invest a minimum amount equivalent to 1 gram gold and a maximum investment worth 4 kilograms per fiscal year. By previous comparisons between various kinds of gold investments, it is clear that the bonds earn interest at a fixed rate of 2.50% per year on the initial investment amount. Interest is paid every 6 months into the investor's bank account, with the final payment made at maturity along with the principal. Let's discuss some safe and authorized agencies for buying SGBs. Investors can buy SGBs from branches of nationalized banks, scheduled private banks, scheduled foreign banks, designated post offices, Stock Holding Corporation of India, or through stock exchanges, directly or through agents. One can also buy SGBs on name of minor. His or her guardian must submit the application on behalf of the minor. Investing in sovereign gold bonds can be done by both ways, online and offline. For simpler investing, consider online SGB investment through your bank's website. SGBs are available for purchase directly from BSE or NSE or through brokers in the secondary market. Online purchases offer a 50 rupees discount from the nominal price. Alternatively, authorized bank outlets provide physical SGB forms for offline applications, which can also be submitted through scheduled banks, post offices, NSE, and BSE. The price of SGB is set in Indian rupees, based on the average closing price of 999 purity gold, from the 3 working days before the subscription period, as published by India Bullion and Jewellers Association Limited. By now we know the taxation benefits on SGBs. Let's reiterate that. First, if you hold SGBs for the entire tenure of 8 years, there will be no capital gains tax on maturity. Second, if you prematurely sell SGBs before maturity, capital gains tax is applicable only on the profit earned on selling SGBs before maturity. Third, sovereign gold bonds offer a fixed 2.5% annual interest over 8 years, paid semi-annually, taxable based on investors' income tax rates. And lastly, SGBs also offer indexation benefits. If an investor holds SGBs for more than 3 years, they can claim the benefit of indexation on capital gains. Indexation helps you to calculate the new value of your investment, considering inflation, and also help to get real capital gain. Is the redemption amount of SGBs fixed? No, redemption amount is calculated based on average closing price of 999 purity gold over the 3 business days prior to the repayment date, as provided by the India Bullion and Jewellers Association Limited. How does a SGB holder receive his or her redemption amount? Both interest and redemption proceeds will be credited to the bank account furnished by the customer at the time of buying the bond. As we reach the final stage of the video, it's important to know procedure for redemption of the bond. Investors will be notified 1 month before the bond reaches maturity. Upon maturity, the proceeds will be credited to the designated bank account. If there are any alterations to account information, such as account number or email addresses, investors must promptly update his or her records. As discussed earlier, while the bond's term is 8 years, early redemption is permissible after the 5th year from the date of issue, on coupon payment dates. The bond can be traded on exchanges if held in demat form and is transferable to other eligible investors. The process for early redemption is simple. To initiate the process, investors should reach out to the appropriate agency or bank at least 30 days before the coupon payment date. It's essential that the request reaches the bank or post office no later than 1 day before the coupon payment date. Subsequently, the due amount is deposited into the customer's specified bank account, as provided during the bond application process. We shall also discuss some other key features of these gold bonds. First, the bond can be gifted or transferred to a relative or friend or anybody who fulfills the eligibility criteria. Second is SGBs are eligible to be used as collateral for loans from banks. Third, in the eventuality of death of an investor, the nominee or nominees to the bond may approach the respective receiving office with their claim. With this we come to the end of our video. When assessing investment options between physical gold, gold ETFs, and sovereign gold bonds, it can be argued that the latter may offer greater profitability due to its backing by the highest financial authority. However, investing in sovereign bonds should be approached after carefully analyzing financial goals and investment timelines, as a significant amount of funds must be committed upfront to realize future returns. With this we come to an end of our video. Don't forget to like, share and subscribe to our channel. Also please read the disclaimer shown in the beginning of the video. Hit the bell icon for notifications about our upcoming, super informative videos.